Well, we didn't have any Fed-related news to start the week, and so naturally stock markets are doing nothing because apparently that's the only thing we care about anymore. A little bit here or a little bit there on the Fed policy outlook is anything these markets need to move. And if you don't get it, we're not going anywhere. So it seems as we start another week now with much more of that kind of event risk. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to look at what it is in the week ahead that's likely to animate investors. And this time around, there is no shortage of it. Last week, we spent a whole long time watching the grass grow and the paint dry until we got a little bit of inflation data out of the U.S. at the end of the week. It was ultimately not the biggest thing to happen. No, the funny thing was that the real big mover was not really something that typically inspires that kind of a response, and that was the ISM manufacturing survey coming out a little bit weaker than expected, and the market's going, oh, good, more rate cuts. And of course, that catalyzed everything around. Gold and silver soaring, bonds moving sharply lower, stocks going higher, the dollar giving back some of its gains from earlier in the week. And so as we start off this week, the real big question immediately in front of us is, now with more event risk on the calendar, and with that event risk more evenly spread, and with its inherent nature more powerful than the releases that we got last week. We have some real big heavy hitters this time. Should the markets be afraid of the Fed? And I think the short answer is, well, they seem to be afraid, and therefore there's market moving potential here. So let's take a look here at what seems to be going on and where we are to kind of benchmark ourselves in this story. And then we'll see where it might go from here as some of this incoming news flow comes across the wires. So, first and foremost, just a bit of stage setting. Here we are, and we can see here that since the beginning of the year, the story has been, that's the beginning of the year right here, the story has been fewer rate cuts, and that's okay. So if last year, especially in the second half of the year, there was a very clear inverse dynamic between how many rate cuts the Fed was on the menu to deliver in 2024 and how much stocks felt good or bad, we can clearly see a pattern. So from about mid-year, you see the stock of rate cuts diminish, stocks decline. Then from about late October, early November, more rate cuts get baked in as the Fed starts to kind of signal that it's done hiking and that its next move is likely to be some kind of easing, and stocks roar higher. Since the beginning of the year, both things have gone up in tandem. And that seems to be because what we are seeing is U.S. economic data that's had a really encouraging run. Data seems to be beating expectations. And so the markets are saying, oh, good, we're shedding rate cuts, but not for bad reasons. We're shedding rate cuts because the economy is strong. So that's okay. Stocks and rate cut expectations can then move into the same direction. And indeed, here's the Citigroup Economic Surprise Index. We can see here, here's the beginning of January, and you can see there's a very clear change of pace here. Second half of last year, data is getting worse relative to expectations. Incidentally, that's not because the outcomes are necessarily bad. It's because already going into that phase in market action, there was a rise in forecasts. The U.S. economy was already doing better. And from about the middle of the year, once we got to the other side of the regional banking crisis, or at least episode 1 of the regional banking crisis, and we got through what was then the concern around some sort of a fiscal knock to growth if a debt ceiling increase was not agreed. Once we got to the other side of that, we started to see an increase in economic growth expectations because the risks were out of the way and the economy had already been outperforming. And so as you raised the bar, the data started to lose its capacity to outperform relative to those now higher forecasts. In that sort of a period where the data is undershooting forecasts, you got the sense that good news was bad news because it meant more cuts were unlikely, and bad news was good news because it meant more cuts were likely. And of course, at the end of the day, the market just wants easier money. Now, as we look at what's been happening since then, the economy has now started to outperform relative to the new and updated, more positive expectations. Although, obviously, with the ISM number last week, there's been a bit of sogginess here most recently. But the overall direction is nevertheless one of a U.S. economy that's doing better than the markets are anticipating. And so, not surprisingly, then rate cuts are falling away. But of course, there's the other side of the story also. As the economy accelerates and rates, as they are expected to land by the end of the year, that's the orange line there, go higher, that's coming alongside a rise in inflation expectation. The kind of bluish line there is the 5-year break-even rate. That's the difference between nominal and real U.S. Treasury yields. So you take the difference between the nominal and the inflation adjusted, and you get the magnitude of the inflation adjustment as a residual. And so that is the bond market's 5-year inflation expectation benchmark there. And we can see that it has been rising right alongside the improvement in U.S. economic data. So as the economy heats up, so too the market starts to say, well, then inflation is going to be higher in the future. That, of course, works against the case for the Fed and near-term stimulus. As inflation expectations go up, the Fed naturally says, well, hold on. We don't want to let the progress we've achieved so far slip away from us. We're not going to cut in any kind of hurry. And this really is where things get interesting, because where we've arrived now is essentially right in line with the Fed's own forecasting. So back in late December, the last time that the Fed issued official forecasts, it said that the likely path for 2024 was 3 rate cuts. That's a 25 basis point move apiece for about 75 basis points. They rounded it to 80. If we look at where the markets were at the time that this forecast was issued, they were more likely to be calling for something double that, or almost double that, between 150 and 160 basis points. Since then, what we see is that the markets have adjusted to the Fed's view as the data has backed what the Fed's been saying. So now the markets are at about 75, 80 basis points right here. And of course, that's where the Fed has been. In fact, comments from Fed officials since December, including Chair Powell, have said, forecasts are probably about unchanged now. We don't really see anything material out here that would change our perspective based on what we said in December, give or take. Okay, so what this means is that we are sitting on the line here, where anything that's further down, further into negative territory on policy odds from here, is likely to still be supportive for risk sentiment, but everything above now becomes relatively tighter against the Fed's benchmark. And from there, If you get anything tighter, you might be in the place where once again stocks begin to wobble and we get into a bad news is good, good news is bad kind of an environment, much like what we saw right here. Note that we had a precedent for this last year. There was a period here where stocks were going up and rate cuts were diminishing because they were seen as diminishing again for good reasons. Easing concerns about the banking crisis, easing concerns about the fiscal picture. And then once you got to a certain point, the market said, okay, well, now this is too few for comfort on the rate cut tally. And so we are now sitting at the line where any more reduction in expected easing, and we're again perhaps in that space where we're seeing too few for comfort and stocks fall over. Now, there's going to be quite a bit on the calendar here that is going to move this story this week. And by far, it seems the most important is going to be a run of 2 consecutive days of testimony from Fed Chair Powell up on Capitol Hill. He's going to start in the House. He's going to go to the Senate the next day. The substance of the prepared remarks that he's going to make, this is a semi-annual update for policymakers, it's likely to be basically the same. The key differences will probably show up in the Q&A. So the House obviously is going to have their own questions. The Senate committee is going to have its own question. And so there'll be opportunities for various new insights, or at least various sound bites that might generate volatility in both sessions. Though, of course, the first session is the one where people are going to really pay attention to what the prepared remarks are. Now, against what we've seen occurring here, it seems unlikely that Powell is going to say anything groundbreaking, but also that the tone is likely to be generally hawkish, at least relative to what the markets want to hear. And that is, of course, for the reasons we've already seen. U.S. economic data has generally been better since the Fed issued its latest forecasts in December. And that better has meant higher inflation expectations. So the message from the Fed is likely to be, look, we're still focused on inflation. We want to make sure it's beaten. We think we're going to have to cut this year. We hope that we're going to cut this year. It's probably not going to happen soon. And it's not going to happen with any kind of vigor if we think inflation is still an issue. Powell will then probably get a gazillion questions about the electoral cycle and the Fed cycle overlapping and saying, well, will you commit not to make moves around the election, or will you be mindful of the election as you decide when to make a move? And Powell will bat those things down. And so the market is likely to come back with essentially the sense that the Fed chair sees scope for maybe fewer cuts and maybe doesn't care about what the political cycle is, and so those cuts might well come later in the year, though that may be adjacent to the presidential election. And frankly, the Fed has quite a bit of cover here. They've been saying that they're looking to aim at cuts since late last year. November is when they started to kind of get the feelers out there. December is when they were much more transparent. And of course, since then, the outright message has been, we're looking for cuts this year. That was in December's forecast. So any kind of attempt to politicize this, maybe the Fed has already neutered because it's already said where it wants to go. Now, the markets being as sensitive as they are to Fed policy gyrations and the possibility that they might signal something more tight than the markets want to see, that could very well wobble stocks here, if that's where Powell takes it, though it won't be groundbreaking commentary. It'll generally echo what he's already said. On top of this, there is economic data to kind of fill out the story. And it sort of bookends the testimony. First, on Tuesday, we get service sector ISM numbers. That's the PMI equivalent from the Institute of Supply Management. It works in PMI style. So above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And as we mentioned earlier, we can see last Friday, the manufacturing number surprised on the downside. 47.8 versus 49.5 expected. So the pace not only remained in contraction mode for manufacturing, but actually accelerated, and the sector shrank faster from January to February, whereas the expectation was that it would shrink slower and almost come back to neutral, at least. For the service side, which is a much bigger part of the economy, and therefore much more significant to what the Fed is looking to achieve, the expectation is we're going to slow a bit from a 4-month high. So from about 53.4 to 53 flat. If this number is going to bring us back into the world where U.S. economic data registers north of forecasts, or there's any kind of upside surprise here, or the number is relatively solid, if nothing else, as long as there's no downside surprise here to echo what happened in manufacturing, it seems like, coupled with a hawkish message, or a relatively hawkish message from the Fed chair, some of the rate cut repricing that's occurred Friday and to some extent Thursday of last week in the wake of the PCE data, that might go away. And we might shift closer toward 75, maybe even 70 basis points. If that's the case, that's probably uncomfortable for stocks. It's probably uncomfortable for gold. It's maybe a tailwind for the US dollar. It might be uncomfortable for bonds, though the combination of risk aversion and rising yields we've yet to really see in earnest in bond markets in the recent price action. So we'll see how that goes. It could be that we actually get bonds higher because stocks are falling, and there is a move toward the relative safety of fixed income. We'll see. But if we do get rates higher because the amount of cuts that is on the menu for this year dilutes back down, then we are likely to get a positive reaction from the dollar and maybe a negative reaction from both shares and precious metals. Then at the tail end of the week, we'll do it again with the U.S. NFP report. Here, jobs growth is expected to slow. 195,000 jobs expected to be added in February. Jobless rate again unchanged at 3.7%. 1.95 would be very much in line with the range that's been anchoring here in recent months. Not exactly a controversial reading. And again, the question will be, unless you get a big downside surprise, does this mean anything for increasing rate cut expectations? And if it doesn't, and the Fed sounds like it's in no hurry, you might again get a punch to stock markets. You might again get a lift of the dollar. And then outside of the U.S., the dollar might get a still further lift from what's going on in Europe. Because the other big event that's on the menu this week is a monetary policy announcement from the Eurozone, the European Central Bank. There's also, incidentally, a policy announcement from the Bank of Canada, but because it comes on the same day as one of the Fed testimony outings, it seems unlikely to overshadow that, especially since much of the conversation there is about what would Canada, which sends 80% of its exports to the U.S., have to say about what's going on in the U.S. business cycle. So rather than looking at the proxy, markets are likely to look at essentially what comes out of the horse's mouth, and so focus on Fed Chair Powell directly. So that seems unlikely to be a big mover, but the ECB may in fact stir some waves. The expectation here, looking at the futures, has become meaningfully less dovish. than what we saw for January's meeting on the 26th and December's mid-month. You can see we've seen a shift in the expected rates curve that's flattened it and made it less steep of a decline. Now it looks like we have the first cut in June to 3.74, down from 4, so that's a quarter point decline there. We again see another one fully baked in by September, down to 3.4% there. And then by December, we're down to 3 and change. So it looks like there's that third cut. Those are all already on the menu, but you can see that we don't end the year at 3.25. It's lower than that. And so actually, if we look at the stock of expected rate cuts, it's 84 basis points. So there's about a 36% chance here that we are going to get more. And so as we look at this, then the question becomes, well, will the ECB endorse it? Will they set the stage to cut in June as the markets are expecting? And they seem to have cover to do it. On the one hand, the economy has been improving a bit, but nevertheless continues to shrink. February, looking at the composite PMI here at 48.9, was the 9th consecutive month that the Eurozone economy shrank. Now, the pace of contraction has helpfully eased a bit as the service sector has basically returned to standstill from contraction mode. Manufacturing is still obviously hampered here. So as we look at this, it seems like the economy is reasonably weak still. It's perhaps not as weak in terms of the pace of contraction. That, of course, is always eventually going to ease. But the overall weakness is very palpable, to say nothing else. And if we look at break-even rates, the measure of inflation expectations, they seem to be anchoring on the German 2-year benchmark below the ECB's 2-year target. So it would seem the ECB is now on track to deliver what they needed. And so now it seems like as good a time as any, really, to begin laying the groundwork and saying, well, if everything continues to develop as we see, we're probably looking to cut maybe sooner rather than later and tilt the commentary in a more dovish direction. That might weigh on the euro, which has been a little bit more buoyant recently, and give the dollar a still further lift on top of any positive development that might come from the Fed signaling it is in no hurry to start this easing effort on its side of the equation. And that is macro money for today. We will, of course, delve into all of these things more deeply and individually as the week progresses. We'll focus on Powell tomorrow. Then we'll talk about the ECB on Wednesday, and it'll be all about U.S. jobs on Thursday as we gear up for this busy week. We're here right after overtime, Monday through Thursday. That's a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what comes thereafter. I'm also on with Chris for Futures Power Hour, on with Tom and Victor for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.